Welcome back to Real Estate Mindset. Today's video is gonna be absolutely bonkers. Now, the data is in, and multiple residential mortgage lenders have currently shut down or are filing bankruptcy. But what's important to know is understand what sector they're coming from, which is essentially non-QM loans and lenders that predominantly relied on refinances to carry them through the future of conducting business. Now, many believe that those factors, topped with a 29% mortgage application reduction, will lead to the greatest lender bankruptcy surge since 2008. However, do these non-QM lenders dropping out of the market really mean that we're in store for another 2008 financial disaster? And is it a sign for things to come for lenders that offer only QM or qualified mortgages? And what we're going to do today, you guys, is really unpack that information. We're really going to dig into this, and we're going to dig into an article from MoneyWise titled, "U.S. Mortgage Lenders Are Starting to Go Bankrupt. How this one factor could be triggering the worst surge of failures since 2008. Now, you guys remember, I'm not your financial advisor, but remember also my bio is as a residential loan officer, and I have been a residential loan officer for over 2 decades. So this article and this report hits home. I believe I have a super special perspective because of my experience in the lending field, and I can tell you that I think companies like my company, Amcap Home Loans, which only do qualified mortgage, I think we're in danger, but I think most of us are going to be okay. Most of those companies don't rely on refinances and don't rely on non-QM mortgages to survive. But regardless, you guys, do me a favor, like this video, subscribe to my channel if you haven't already, and do me a favor throughout watching this, comment below. I read every single comment. Now, let's get started. The real estate market just can't catch a break. With inventory of resale homes remaining low and rising interest rates making it harder for buyers to justify making the leap, and now we can add mortgage lender bankruptcies and the rise and fall of non-qualified mortgages or non-QM mortgage to the factors aggravating an already uncertain market. But what does the trouble around these non-QM mortgages really mean? And what does it mean for non-traditional buyers trying to get a foothold in the market? So it is true, rates are continuing to go up. It's also true that inventory appears to be plateauing, and it is likely that in many metro areas that inventory will decline. And now with potential mortgage lenders going out of business, what does all this mean? Let's continue to unpack the article right now. A non-qualified mess. Non-QMs use non-traditional methods to income verification and are frequently used by those with unusual income scenarios, are self-employed, or have credit issues that make it difficult to get qualified for a mortgage loan. They've previously been touted as an option for creditworthy borrowers who can't otherwise qualify for traditional mortgage loan products. But with First Guarantee Mortgage Corp and Sprout Mortgage, a pair of firms that specialized in non-traditional loans not eligible for government backing, recently running aground, real estate experts are beginning to question their value. First Guaranteed filed for bankruptcy protection, while Sprout Mortgage simply shut down earlier this summer. And it's crazy. It's crazy that they already shut down because we're just coming out of the biggest refinance and purchasing boom, and it's only like less than 6 months of tightening. I can't believe they've already shut down. I know both of those companies well because of what I do for a living. In the documents tied to its bankruptcy filing, First Guarantee leaders said once interest rates started to climb, lending volume dropped and left the company with more than $473 million owed to creditors. Meanwhile, Sprout Mortgage, which leaned heavily on non-QMs, abruptly shut down in July. Now, here's what's really interesting, you guys. These are two of the biggest players in the non-QM niche. So the fact that they actually both stopped lending and stopped doing new financing, it actually is a little bit alarming. But let me explain more so what non-QM is and how it helps people, because a lot of people are fearing a tightening up in the lending industry and even a liquidity crisis. But what I can assure you is most people do not use non-qualified mortgages. The basic advantage of using non-qualified mortgages are loose income verification. So non-QM essentially makes it a little bit easier to verify your income, usually by using something called a bank statement income verification loan, which allows underwriters to use the average amount of deposits made into a business checking account as income. Obviously, a certain formula exists, but the thing is most people don't use that bank statement only program. And the other people that will affect is foreign nationals, and that's where they may have great credit, but when they come here, they don't have great credit. So foreign national programs were also pretty big with non-QM lenders. So it is going to hurt, but I don't think it's going to hurt, drastically per se, not, as far as the number of people, but I don't believe it's going to be anything like 2008 yet. Although I'm more worried about the 29% decline in residential mortgage applications. Regardless, let's finish out this article right now. Do non-QM signal another housing meltdown? Probably not. Most housing market watchers believe today's conditions, led by stricter lending rules, means the U.S. is likely to avoid a 2008-style housing market meltdown. But failures among non-bank lenders could still have significant impact. The non-QM share of the total first mortgage market has begun to rise again. Non-QMs made up about 4% of the market during the first quarter of 2022, doubling from its 2% low in 2020, according to CoreLogic, a data analyst firm specializing in the housing market. So do you see how low that is? Only 4%. Part of what has contributed to the recent popularity of non-QMs is the government's tighter lending rules. Today's non-QMs are largely considered safer bets than the ultra-risky loans that helped fuel the 2008 meltdown. Still, many non-QM lenders will be challenged when loan values start falling, as many are now with the Federal Reserve's moves to raise interest rates. When values drop, non-bank lenders don't always have access to emergency financing or diversified assets that can help tap like larger banking lenders like we do. And that's what my point is, guys, like Amcap home loans. And I'm not trying to, plug them, although I really trust them, heavily. We do qualified mortgage purchases. So we're okay. Again, though, the 29% decline in mortgage applications, that's going to hurt everyone in the industry. That's just a fact. Banks can also lean on safer qualified loans because they factor in traditional income verification, more stringent debt ratios, and don't carry features like interest-only payments. It is important to note that if you have a mortgage through a lender that's now bankrupt or defunct, that doesn't mean your mortgage goes away, right? You still make your mortgage payment, obviously. Typically, the Federal Deposit Insurance Corporation, FDIC, works with other lenders to pick up orphan mortgages, and the process happens quickly enough to avoid interruptions in paying down the loan. All right, so pretty interesting article. I hope you guys are getting a better idea of like non-QM versus QM. So one, QM lenders, it's less risky. They're doing strict verification of income, tighter restriction on lending as far as debt to income ratio and things of that nature. So I hope that made sense. So in other words, like non-QM is like subprime loans, like your stated income, although way different still versus 2008, because traditionally non-QM loans or subprime loans, you need 20% down. In the past, you needed 0% down. So obviously in the past, it was much worse. I could tell you that because I was a part of it. Now let's finish out the article. One number rules them all. While many factors drag on the real estate market, one data point carries the most significance: interest rates. With the Fed's laser focus on raising interest rates to cool inflation, there's little reason to think the effect of lending and the broader housing market will ease anytime soon. Higher mortgage rates, the average 30-year fixed rate was still above 5% as of August 28th, will dictate how much more they can afford. Obviously, that's a lot higher. It's in the 6%. Between a potential shakeout among non-bank lenders, more stringent lending rules forced on banks, and the Fed's higher rates, there are many reasons for caution on all sides. buyers, especially those carrying traditional loans, to the offer table will need to be buttoned up. And here's what they're saying that I think is ridiculous. Listen to what they're saying next. In addition to making sure their credit is in order to meet tightening bank lending standards, they may need to consider other tactics, such as offers that are higher than the seller's asking price and other concessions, such as waiving repair costs for problems uncovered during inspections. What does that have to do with tightening lending standards? If anything, it should be the opposite of that. We should be even more unicornish. We should have even more importance as buyers because it's tighter. That's ridiculous. That statement is so ridiculous. On the flip side, sellers may be more motivated by all cash offers. Sellers are going to be motivated by any offers, but whatever, which typically speed the closing process by removing traditional mortgages and rising interest rates from the picture. As for would-be sellers, they may want to consider waiting to list their homes until the next upswing. Despite geographic pockets of rising values and home demand, a broader nationwide cooling trend may make staying put a good choice. So do me a favor, you guys, comment below. Let me know if you agree with their advice. Should we just waive our inspections and offer over asking price? Like, this is crazy, right? Why would they still say that? We're in September. That's crazy that that would even say that. But there's basically two things that I kind of want to bring to light. Now, the first thing is non-QM lenders are not the same as QM lenders. Traditional QM lenders are going to be in much better shape. Now, the other thing is, even though there was activity for non-QM lending, it still requires a significant down payment, unlike 2002 to 2007, which often required no down. The second thing is interest rates are absolutely governing and leading our market. So the lenders that can survive probably 12 to 24 months and weather this storm, in my opinion, are going to be perfectly fine. But the next 12 months to 24 months are really when until the Fed pivots is when lenders like where I work are going to be at the most at risk. So you better make sure, if you are a loan officer like me, you work with the right lender. Now, other than that, you guys, I really appreciate you watching this video. I hope you got value from it. And if you're out there investing in real estate, I wish you luck and I hope you win.